Hello and welcome to this new video brought to you by Drift Protocol. Today we're going to talk about market liquidity and order flow. Drift is a lightning fast and scalable perpetual futures DEX on Solana. If you haven't checked it out yet, please do. You can trade Atom, Luna, Ethereum, Bitcoin, and Solana. So quick disclaimer, this video is not financial advice and neither Drift nor Xerox Nemisa are financial advisors. This video is for entertainment purpose only and trade at your own risk. Quick summary, we're going to talk about market and limit orders first, finished and unfinished auctions, resting liquidity and SFP, market making, and then we'll conclude with supply and demand trading. So regarding market and limit orders, what we want to emphasize here is that how they interact with each other to make price move. So for market orders, it's like saying to a centralized exchange, I'd like to buy X lots right now at the available price. And when you do that, you're a market taker. For a limit order, it's like saying, I want to buy X lots later at the price that I choose. And where you place limit order, you are a market maker. And those orders, those limit orders, they're going to end up in something we call an order book on the right here. And so on the left of this order book, we have all the limit buy placed in the book and all the limit sell right here on the right placed in the book. So let's say you want to buy 6 Bitcoin with a market order right now. What's going to happen is that you're going to consume the limit sell orders of the order book. So you're going to consume the 4.06 here and you're going to consume 2 here. So since this price has been consumed, we're gonna come to 42,022 and it's gonna be the new price, the new trading price of Bitcoin. So every market order leads to consumption of limit sell orders and every market sell order leads to consumption of limit buy orders. So depending on how thick the order book is, price is gonna move fast or slow, and this is what we refer to as liquidity. So if there's a lot of orders in the book left and right, this is considered as a very liquid asset. Whereas if it's very little orders placed in the book left and right, then it's going to be very illiquid. And so stop orders, they can either be limit or market. And so for an illiquid market, it is better to use a stop market order. Now we're going to talk about finished and unfinished auctions. Unfinished auctions, they happen when the market prints 2 or more highs or lows at the same level. So for example, here we have an unfinished auction with like almost 1, 2, 3, 4 highs at almost the same price. So what that means is that multiple participants were trading at that level, and which means that the auction is unfinished. And so the market will typically proceed to fix this inefficiency to terminate the auction. And so here we have unfinished auction on the top and unfinished auction on the bottom. And the opposite is a finished auction, and finished auctions are also called excess, and they signal the end of an auction in one way and the beginning of a new one on the opposite side. So excess tend to trap traders on the wrong side of the market and revert very swiftly. So here we had this unfinished auction here and unfinished auction there. And so we essentially went down, finished this unfinished auction through this finished auction here, and then revert very swiftly and then terminate the auction in the other way and proceed to move higher. So to sum up, unfinished auctions are equal highs or lows, while finished auctions are candles with long wicks. Regarding resting liquidity, what we want to talk about here is the type of orders resting below support and above resistance. So here in this example, we have a support level with a double bottom. And what's going to happen is that the first source of liquidity is going to be long traders. So longing from here, for example, and they're going to place their stops below support. And the stop for a long trader is going to be a sell order. For the second source of liquidity, are breakout traders, and breakout traders are guys that think the market is going to go further down after we go below support. So these guys are going to short here, and they're going to also be sell side liquidity. On the other side of these guys, we're going to find large size traders, for example. So these guys typically will have limit buys, stack limit buys, so here at different level. And when the price will dip below the support level, the first two guys, long traders and breakout traders, are going to have their sell orders interfaced with the limit buys of the large size traders. So it's very important to kind of pay attention to obvious levels where liquidity is going to build up. So for example, here we had two, liquidity here and liquidity here, and these are essentially like just pools of swimming liquidity. And what we see is that the market takes down liquidity on one side and then proceeds to go to the other side. So if we had the other scenario where the market would have taken, liquidity here, then we could assume that it would have gone down after that. And so you can adjust your trading based on your reading of what the market is doing. Swing failure pattern. So SFP, in short, happens when the price action takes out a former swing high or former swing low and closes below or above it. So in this example, we have two SFPs, one here and one here. So here we have a former swing high, and we see that the market is taking out the swing high and revert on the other side. So it is a finished auction. And here we have a former swing low, and this swing low is taken out by the market, and we revert on the other side. So SFP are interesting because when you notice them, they can provide potential entries for your trading. And typically after SFP, you're gonna have some kind of pullback, which should lead you to enter a trade. And you can even go on lower time frame to refine your entry. So we're gonna do that. So this is the same chart, but on lower time frame. So you got your SFP here, another SFP here, and then this is the pullback that we've seen on the higher time frame. And what you see even on the slower time frame is that you got another SFP going on, and this should be your trigger to entry. So if you enter here, around here, you would have a very good trade from 135 to like 141 if you target the range high. And what you see even on the SFP on the lower time frame is that you get even a pullback for potential second entry in case you missed this one. Market making. So market making is something that is completely misunderstood on social media because most people think that market makers move markets, which is actually not their business, but they do the opposite. So contrary to popular belief, market makers are liquidity providers, and they provide a passive two-way price. And so market makers, they want to be as delta neutral as they can, which means they don't want directional exposure to the market, and they make money between on the spread between the bid and the ask. So here we have a classic setup for market making with the mark price, so the current trading price. And what market makers do is that they will distribute buy limit orders and sell limit orders at small intervals with a distance to the mark price, so below and above. And the distribution of their size will vary depending on the distance with mark price. So what they do essentially is just they make money between the bid and the ask on the spread. And so when the market gets imbalanced and trending, it's actually not good business for market makers because they have to rebalance their position to avoid directional exposures. Supply and demand trading involves longing at demand zone and shorting at supply zones. What we mean by that, by supply and demand zones is that, for example, demand zones are gonna be down move before impulsive moves like we see here. And supply zones are going to be up moves before impulsive down moves. So here we have a clear demand zone. So when you try to identify the supply and demand zone, the first thing to do is to look for big impulsive candles like we have here. So we have this big impulsive candle, and before that we have a down move. And that down move is going to constitute the demand zone. And so what we want to do is try to create a trade around that demand zone. So I'll give you an honest, feedback about this trade. And what I would have done is essentially, we're in the demand zone. We have an unfinished auction here. We have a SFP. So what I would have done, and the SFP would have been my trigger. What I would have done is enter at a pullback after SFP and put my stop below the SFP. And as you can see, it would have been stopped out. So it is to show you that SFPs are not foolproof, and that you're gonna get stopped out sometimes, but that's definitely normal, and that's part of the trader's life. So one way to avoid getting stopped out in that example would have been to enter after a close above the demand zone. So here. Or you could have just wait for the first pullback and enter on the first pullback. So another example here, this is on the weekly, and this was in the 1 hour. So it's good to show you different time frame examples. Here we have sushi and we have a supply zone. So big impulsive down move, and what we have before is an up move. So this is gonna constitute your supply zone. And as we can see, there's a retest of the zone, and then we proceed to move down. So one thing that I also want to emphasize about supply and demand trading is that, you can look, so this is the same chart actually. This is on the weekly and this is on the 8 hour. And, to refine your entry, because on the weekly it's quite hard to define a clear entry. So you can go on lower time frame and see what's going on. And so you have your high time frame supply zone here. And you see that this move up, as we go up, we also have a divergence appearing clearly on the oscillator. So you have a divergence appearing on the oscillator with price action. So divergence, again, you have a high here, a higher high here, and here on the oscillator you have a high and a lower high. So we have a clear bearish divergence, and this bearish divergence is appearing, as we enter a supply zone. So definitely it should be a short signal. To continue on supply and demand trading, the high time frame market structure should help establishing your bias and whether you should be looking for longs or shorts. So for example, here you have a high, a low, higher low, and so on. So your market structure is definitely bullish and you should be looking for longs, right? So from that, again, you should look for, impulsive moves like here, and mark the demand zone preceding those impulsive move. Demand zone if, again, we're looking for longs. And so as you can see, what happens is that this demand zone got tested here, but this one didn't. So again, it's not a foolproof system, and some zones are going to be tested, some zones are not going to be tested. So what happened here is that you had a SFP of the swing low here in a demand zone. So, and you see a very nice reaction. So your entry should have been something like the over and under pattern here that we see. So we went down, we had a low here, we broke that low, did the SFP in the demand zone, kind of reclaimed that level right here, and then this should be your entry. And again, same thing that we mentioned earlier, SFPs is always a pullback right after, and that's when you should enter. In that case, this pullback is in line with an over-under pattern. And so what will happen actually when demand zones are retested is that if there were guys that were shorts this whole time, when price is gonna come back to the demand zone, they're gonna close their shorts. So it's gonna be pipe pressure because their sell orders are gonna close, and to close that, they're gonna use a buy order. And then you also have all the guys that bought here. When we come back here, they're gonna probably double down and defend their position. So you have two sources of fuel to go higher. So as a conclusion, let's take a quick review. We talked about market and limit orders. So markets move with market orders consuming limit orders on the order book, with the liquidity being referred as the thickness of the book. Unfinished auctions, which are double tops or bottoms, are considered as poor structures that are likely to get fixed through finished auctions, which are excess. Resting liquidity will build up above and below unfinished auctions or swing points. And so you should look for this potential, liquidity building above resistance or below supports. And the market is gonna tap into this building liquidity with patterns like SFPs. Market makers are delta neutral as much as they can. They don't make money by moving the markets. They make money by providing a two-way price, a passive two-way price. So on the spread between the bid and the ask. So they don't move markets because it's actually bad for business, because they will have directional exposure. And then lastly, we talked about supply and demand trading. So supply and demand trading is definitely an interesting method that allow you to understand the flow of orders taking place in the markets. Thank you for watching this video, and we'll see you soon.